Hard currency scams, like pretty much all investment scams out there, they ebb and flow. Essentially, as long as there is enough people to buy into the scam, they'll be pumping out full force. And then they kind of die out. They just scorch the earth. And as things are just starting to get back to normal and people are forgetting about a particular scam or a new group of people is available to be scammed, they'll reemerge. And we're seeing one actually reemerging right now with a surprising amount of popularity. It's a hard currency scam around the Iraqi dinar. Now, this is one, we love to talk about investment scams because we feel like it's a great way to provide a contrast between what's a real investing principle and what are the common denominators behind pretty much all scams. There's some level of fraud, certainly misleading information, and ultimately no disclosure of risks and an overstatement of potential return. And we're going to go through that with looking at the dinar as our case study, because this is not the only one that we'll ever see. It's the one that's popular right now, but it won't be the last one. The scam goes along something like this. Essentially, a dinar dealer contacts you or advertises to you and says, look, if you want to invest in the dinar right now, which used to be worth, pre-Kuwaiti war, used to be worth about $3 plus. So one dinar was worth $3 US. But right now it's worth a fraction of a penny. That's true. About 1,000 dinars to the dollar right now. Now, if, once the economy starts to normalize and begin to grow, well, that currency is going to appreciate it. Even if it just appreciated to a penny, to where one dinar was equal to one US penny, that'd be a 10 times return. Now imagine what would happen if the dinar appreciated to its pre-war value of $3. And in fact, as proof of that this can happen, that's exactly what happened to the Kuwaiti dinar following the war there in the 90s, and it's exactly what happened to the German Deutschmark after World War II. Well, then subsequently, you're enticed to basically buy hard currency. This isn't a bank deposit or something like that. They'll actually ship you new Iraqi dinars. Now, so what's the problem with all this? I mean, let's say that you go ahead and do it. And I've heard personally from people who've invested anywhere from $500, which is probably not that significant, to $20,000, $200,000 in this particular scam. So what's the problem? Well, it kind of starts with the dealers. So let's talk about them first of all. So number one, the dealers have basically one big problem, and that is that they're marketing an investment. Now in the US, as well as most major economies, it is illegal to market an investment product without proper registrations, which one of the things you have to do with proper registration, you have to disclose risks. And in fact, you have to equally disclose, you have to place as much emphasis or equal emphasis on those risks as you do the potential rewards. Now, these dealers are not registered, and they get around this in two ways. Number one, they market the dinar by its numismatic values. In other words, it's a collector's item, so it's like a coin dealer. Or they'll do another thing where they'll register themselves as a money service business. So, and what that means is that's like Western Union when they're sending wire transfers, Western Union wire transfer, or it's like convenience stores in the U.S. who sell money orders, or the exchange rate place in the airport where they'll exchange your dollars. That's what those businesses are, and they register with the U.S. Treasury as a service provider, not as an investment advisor. So you will oftentimes see this advertised, we're registered with the U.S. Treasury, but you should ask, what exactly are you registered as? Because they're not going to be registered as an investment advisor. So that's how they get around that. Now you have to ask yourself at that point, well, if they're starting out this investment relationship dishonestly, how legitimate could this investment opportunity really be? And that's actually where we get into, we need to kind of take one more step here before we start talking about, okay, how do they convince you that this is a good opportunity before you get into number three, which is, what are the real problems with this particular trading strategy? So let's talk about this opportunity, because oftentimes they'll use the examples of, well, this exact same thing happened to Germany in the Deutschmark, so World War II, or going back in history a little bit, and it happened in Kuwait. Well, there's fundamental differences. One of the primary differences, of course, is that neither one of those two currencies at the time were free-floating currencies. That means that their value was a policy decision, not it wasn't a liquid market like you might trade the euro versus the dollar or something like that. That didn't exist in that way at that time. It's an apples and oranges problem. Second, there's a fallacy here where they're attributing that the Kuwaiti dinar post-war is the same thing as the Kuwaiti dinar pre-war. It's not. In fact, there's been two other versions of that. The pre-dinar, it was demonetized, and you had a certain amount of time before you could convert that over to the new Kuwaiti dinar. This is a major problem with hard currency investors, because if you're in the US or Germany or wherever you are and you're holding big stacks of Iraqi dinars and they decide to demonetize them, what do you think you're going to do with those? Where exactly are you going to go take them to get them converted into new dinars if they do that, which is very, very common, by the way. Pre-World War II Deutschmark, not the same thing as the post-war Deutschmark. So they're creating a connection there that didn't really exist. In fact, if you look at recent revaluations or recent currency issues where there's been currencies whose value, the base unit value, was very, very low. So think Turkey, think Venezuela, think Mexico. You'll find that they didn't appreciate, they didn't just let their currency appreciate, they actually changed its value, and we're going to go into that here in just a minute as to how that presents a bit of a risk. Second, one of the real issues is that they'll say, well, okay, but forget about Kuwait and forget about Germany post-World War II. Just think about Iraq. You know, before the war and before the embargo in 1990, you had $3 would buy one Iraqi dinar. But that was an exchange rate, again, not free-floating. In fact, it was an exchange rate that was arbitrarily set by an autocratic regime led by Saddam Hussein. So you can do that, by the way. It's extremely expensive in the modern age. And as the currency market has been trending more towards a free-floating model over the last 30 years, that's becoming much, much more difficult. So you can't look at that particular value as being something that was established by a marketplace. It was established by Saddam Hussein. That's a very different way to derive your currency's value than, for example, in an open market like you may see the dollar or the euro or the yen or the pound or something like that in today's market. So again, apples and oranges, not the same thing, not even close. So let's talk about what are the real risks with with actually holding a hard currency like this and speculating that it will appreciate in the future.